Good afternoon. You're all very welcome to today's webinar, Accounting Treatments for Cloud Computing and ERP Investments. You will see the Q&A button on the bottom of your screens, and as all attendees will remain on mute for the duration of the webinar, you're welcome to input your questions here and they will be answered at the end of the session. We will be recording this webinar and will provide you with the link via email after the webinar. I'm delighted to welcome one of your fellow members, Diarmaid Cowhie. Diarmaid is the current Vice Chair of the CGMA Southern Branch Committee, and this is the third webinar in the ERP series. He will explain what cloud computing is, the constituent parts of cloud computing investments, and the accounting treatments your organisation should consider adopting under both UK and Irish GAAP and IFRS. With that, I'll leave you in Diarmaid's capable hands. Welcome, Diarmaid.
Thank you, Jean. Welcome, everybody, and thank you for joining this afternoon's session. As Jean said, this is the third in a series from CGMA's Southern region. The first was in February of 2023, ERP for small and medium-sized enterprises. That was delivered by my committee colleague and this year's current Southern Region Chair, Mary Hayden. And we also had an event last October 2023, ERP Building for the Future. That was delivered by DataPack's Richard Murphy. Just before I get into the slides, just want to give a standard caveat. I personally do not work in practice. This presentation is for educational purposes and does not constitute professional advice. Please contact your accountants or auditors if you need tailored guidance for your own organization on anything you see as part of this presentation. And another caveat around taxation, this presentation does not include any guidance or information relating to taxation. Just a little bit about myself. I'm a member of CGMA since 2015. I worked in various management accounting and financial management roles in the UK and Ireland. My most recent accounting experience were specialist insurance and claims accounting roles, but I also was working in risk management during that time as well. Prior to working as an accountant, I worked as an engineer, originally designing and testing software systems for industrial clients, and I held various operational management roles within engineering organizations. My current role, I'm a member of my organization's Chief Information Officers team. My primary focus has been on my organization's investments into future IT equipment, IT processes, software, and systems. And I frequently find myself acting as a translator, advising my accounting colleagues on technology developments and advising my IT colleagues on financial control. This presentation is grounded in that recent experience, preparing business cases and capital investment decision papers for executives and boards, raising awareness of the emerging nuances around IT investments with senior decision makers, dealing with those senior decision makers' objections, and leading them through the necessary changes. Those experiences are what is at the heart of this presentation. I focus on making the information in this presentation as accessible as possible, both to finance and IT professionals. My hope is that you, as finance professionals, will come away from this with a greater understanding of cloud computing and feel equipped to engage with your IT and engineering colleagues with greater confidence and competence. I am not going to read through 17 slides. I'll speak over approximately a dozen of these slides. The slide deck will be shared by Jean afterwards, and you can drill down into some of the additional details. The relevant accounting standards are publicly available to download, and I've included some links in Appendix 3 as well. For the sake of shorthand in this presentation, with reference to FRS 102, Financial Reporting Standards applicable to UK and Republic of Ireland. I will use the shorthand UK and Irish GAAP. Where I reference, for example, IAS 38, intangible assets, or similar international accounting standards, I will use the shorthand International Accounting Standards. The slides themselves use a mix of both. And as exciting as it might be to research the history of accounting standards, I take a chicken and egg view on which preceded the other. I'm sure somebody knows. I'm just not an accounting standard historian. So where I make a comparison between UK and Irish GAAP or international accounting standards, that comparison is grounded in the level of detail in the documents and not in which standard came first. To set the stage, I just want to share a few explanatory terms and illustrations. And I want to describe what an on-premises setup is, and in a second, what a cloud computing setup is. And I'll illustrate this with everything we're all familiar with, your own office. So in plain English, you have your physical office, you have your desk, you have a bookshelf, and filing cabinets. The books on your bookshelf are analogous to computer software, Excel, Outlook, Word, any accounting software you use. The filing cabinets are analogous to the folders and files where you store the work you're doing. Spreadsheets, emails, documents, journals, etc. In your own office, to access your bookshelf or your filing cabinets, covering these distances takes a few seconds. You have near instant access to your software, in your folders, and in your files. And that point of distance and access time will become important on the next slide. In a cloud computing setup, your bookshelf becomes your library, becomes a library. You access the books alongside people from all over the world. Your personal and shared filing cabinets are now a warehouse where you and millions of other people all over the world keep those folders and files. And this is where my previous point about distance becomes important. You can see on the screen here, I've included 1,000 kilometers to the library and 2,000 kilometers to the warehouse. In a cloud computing setup, you still have near instantaneous access to everything, whether it's your software or your folders and files. Despite the warehouse and the library potentially being thousands of kilometers away, you can still access those folders and files near instantaneously. And that's all cloud computing is. It simply relocates your software, files, and folders away from your own premises and then removes them or moves them to a remote location. The data, your software, your files and folders, in the first on-premises scenario, they were stored on computers located in your organization's premises. Your organization controls that equipment and the data stored on that equipment. And the use of the word control is important, and I'll come back to that in a while. That same data, the software, files, and folders, in the second cloud computing scenario on the screen here, is now stored on computers in another organization's premises. Your organization pays that organization to host your data. Now, there are benefits and risks to cloud computing. And as I'm sure you can appreciate, one organization's benefit is another organization's risk. Where you see a threat, others see opportunities. So this isn't an exhaustive list, rather it's an attempt to provide a balanced perspective on cloud computing. There are a number of benefits of cloud computing. The first I want to call out is business continuity and disaster recovery. In the event of a catastrophic event, a fire, a flood, etc., your data remains intact. Your organization can continue to function, whether remotely or at a different premises. Another benefit is that you can avail of the latest software versions seamlessly. And those can include workflow improvements, efficiencies that come with the latest software. Security is a double-edged sword. So I'm including it here as a benefit, and you'll see it in a minute when I reference risks. From a benefits perspective, you are entrusting your data to a third party. It's in their interest to provide you with as secure an environment as you can afford. Their professional reputation and standing in the market is dependent on it. From an end-of-life perspective, you may have hardware that's old, so you need to replace that hardware. By moving to the cloud, you remove the need to have to replace that hardware. You are potentially reducing or eliminating the need to perform regular, potentially expensive upgrades or renewal programs on out-of-date equipment. And this has a number of other benefits as well, which I don't mention here. You're potentially freeing up physical space on your premises, and you are not paying directly now for the electricity for running that equipment. And there are also sustainability benefits with your cloud computing provider running your data on the most efficient equipment. But as I said, there are also risks. And what I've done here is I've included some of the mitigations that you should consider for those risks. The first, obviously, is internet connectivity. You are dependent on having a reliable internet connection. This is potentially a single point of failure. So the mitigation around this risk is you need to very carefully select a reliable provider for your internet services. Staff engagement is another huge risk that I've personally seen and continue to deal with on a regular basis. I'll just paint a picture historically. When computers were first rolled out across organizations, Windows 3.1 back in the early to mid 90s, with early versions of Excel or Lotus Notes. That was when most organizations really began to embrace individuals having their own IT system on their own desk. And for those of that vintage, you may remember receiving extensive training when that equipment landed on your desk. Not anymore. People are expected to be IT literate. And that's just not always feasible to expect everybody to have the same level of IT competence. That's why the mitigation I list here, well-funded training, dedicated change managers are necessary to guide staff through the migration to cloud computing setups. And that in turn will improve staff engagement. And as I mentioned under the benefits, the other side of security. There's a principle in risk management that the business owner is the risk owner. Organizations in a cloud computing setup are outsourcing their IT security to third parties. That does not diminish the business owner's responsibility for the security of their data. No more than if the business owner had hired a dedicated internal IT security resource. All you're doing is delegating the maintenance of the security to somebody else. To mitigate this, regular account management interfaces with the cloud computing service provider to track their performance. That performance being underpinned by service level agreements with very sharp teeth, that is, robust penalties. And above all, vigilance for that service provider's performance. All of those things will help mitigate the security risks. Finance is a balance. It's either a benefit nor a risk, or it is both. From a purely savings perspective, as I mentioned previously, you're maintaining less IT hardware. You're not depreciating a load of assets. You require a few IT staff to maintain that, or fewer IT staff to maintain that. And you may also benefit from having insurance savings. But on the flip side, there are operational costs. You are now paying for a service to host your data, your software, your files and folders. And there may be costs associated with security enhancements, updates and upgrades. An investment decision around cloud computing application needs a cost-benefit analysis. You need to balance those savings with those costs. And looking at that risk analysis through the lens of risk appetite, weighting it for your risk appetite is extremely important. And I'll illustrate that with an example. While you may not need lower cost junior IT people now, because you've outsourced the bulk of it, you may need to still retain expensive IT managers or account managers to manage the contracted service. You're now running into succession planning risks, etc. There's a lot to unpack. So look, I'd strongly encourage you to speak to your IT leadership and quantify those risks as part of that cost-benefit analysis. I'll pause here now for a second. This next slide includes different investment scenarios. These are examples that I have come across myself, and you and your organization may currently also be exploring. Each scenario involves some element of cloud computing, and they are frequently part of broader IT and system investments. And there's an old saying, and I've heard this about those who drive motorcycles. I personally don't. There are two types of motorcyclists: those who have fallen off their bike and those that will. It's similar for accountants. Those that have been involved with upgrading their organization's accounting systems and those that will. Whether it's the requirement gathering, it currently does this, I wanted to do that. Whether it's a design input, whether it's oversight of the project's progress and budget, and testing, so much testing. There are accountants on this call who I know are wincing in their seat now, having gone through the trauma of that experience. So the more familiar you are with these investment scenarios, the better equipped you will be when you are participating in them. The first scenario I want to talk about is a system upgrade. And going back to the theme of this series of lectures, an ERP, enterprise resource planning upgrade, or your accounting systems upgrade. These are dedicated software for particular standalone operational functions. Your ERP may have sales and order management. It may have logistics. It may even have a management information system that may link to something on your production lines. In our private lives, upgrades to smartphones, they just happen. A new feature is added to an app, or an app slightly changes appearance, but it's still intuitive to use. But in our professional lives, system replacements are far from seamless. They need planning, finance, training, etc. Migrating those standalone operational software to the cloud will still need those activities. You still need to plan, you still need to finance, and they still manage the finance, and there will still be training. But once it's up in the cloud, those system updates that I mentioned here on the slide, they can happen far more seamlessly, often in the background. Incremental continuous improvement that your cloud computing contractor rolls out and you benefit from. The best example that comes from mind for me are security updates that sit at your cloud computing service provider's premises. The next one I want to mention is websites or intranet development. This is self-explanatory. Your organization will either have outward or inward-facing web portals. You could also extend this to any apps your organization deploys for dealing with customers or staff. I want to call it legacy systems here for a second, just slightly different to the first point on system upgrades. These are upgrades where the system being updated or upgraded is very old. I recently came across a scenario where the equipment and its associated software dated back to the 1980s. and another scenario where the data on a different system went back to the 1950s. From a financial perspective, these are assets that are long since depreciated, but you may be still holding key information for your organization. That could include payroll information, staff health-related information, insurance, legal information, and the most obvious long tail information, pensions information. Obviously, data protection and GDPR is a relevant consideration. What is the legitimate business reason for holding on to this data for so long? But purely coming at it from a risk management perspective, migrating this data across to a secure, backed up, cloud-based storage will reduce your organization's risks about data loss. And again, from another data protection and GDPR perspective, it will make those frustratingly inconvenient subject access requests a lot more efficient. My last point on this slide is with respect to data migration, and it is linked to the systems upgrade from the legacy system previously. It's a specific scenario that comes to mind for on-premises network drives. This is where your data is currently stored on premises on your own servers in your own building. The data migration is moving that information from your on-premises equipment and moving it to Microsoft products like SharePoint or Azure or Google Workspace. Everything up to now has been an extended introduction, a foundation for me upon which to build the rest of this presentation, the accounting treatment. And just before I dive into this, I'm not going to bombard you with slides of dense text now. I'll speak over what you can see on the screen. Jean will be circulating these slides to attendees afterwards. I have included additional appendices below in the presentation. I'm not going to go through these now, but they will provide some additional color and additional information with reference to both UK and Irish GAAP and international accounting standards. That said, let's get into it. Each of the investments listed on the previous slide will more than likely be delivered under a project, and those projects will have different implementation phases. This first slide here relates to the treatment of those different phases through the lens of UK and Irish GAAP. And I'll get to the international accounting standard perspective in a while. Whether the system is being acquired off the shelf as a separate acquisition, or is being developed internally by your organization's own IT resources, an internally generated intangible asset. Both of those scenarios, off the shelf or build it yourself, will require a project. Each of the different implementation phases will attract a different accounting treatment. And the accounting standard that governs is FRS 102, Section 18, intangible assets other than goodwill. Again, I'll choose UK and Irish GAAP as I'm referring to that as shorthand. This goes into a huge amount of detail around the principles that need to be applied around the recognition of the costs, whether you expense them or capitalize them. The first thing is you need to be able to reliably measure the costs. This may not be as straightforward as it sounds. It's one thing having an invoice from a supplier, that's straightforward enough, but you may need to put processes in place to track time, the cost of IT professionals or engineers in your organization who may be working on multiple projects. This will require close collaboration with your IT colleagues. It may require timesheet processes, and it may require robust project management processes as well. Let me start with the first first implementation phase, research. As the table says, any research costs need to be treated as an expense. And just to explain the table here, this reference here, 18A E to G, this is the subsection of FRS 102. And you'll see that as I go down through the rest of this slide and when I get the international accounting standards slide in a minute. I'll include this reference here for ease of your own reference. I do include the detailed text down in the appendices as well. Research. This includes any costs incurred gaining new knowledge. It includes searches for any alternative systems, any alternative services, or any processes or time spent evaluating those research findings. All of that cost needs to be treated as an expense. For the sake of ease of presenting, I group the following expenditure types under the umbrella of startup costs, but they do occur at different times, potentially in an implementation project. These include the creation of any internally generated brands, logos, customers lists, etc. Any establishment costs for legal entities. Training is an expense. Advertising and promotion activities. Relocation and organizational costs. And any internally generated goodwill. Each of these is to be treated as an expense during the implementation phase for your cloud computing project. The one that most people find jarring are training. These costs are specifically called out as being an expense. I have had numerous conversations over the last 10 years with colleagues and peers around this. This is not unique to intangible assets. The same principle applies for PPE, property, plant, and equipment. What can be capitalized are system development costs. These can include design costs, build costs, any testing costs for new processes, systems, or services. Your organization needs to be able to reliably measure these costs, must be able to extract future benefit from them, and must intend to use or sell them. There are other principles around the capitalization in the appendices, but what I've just mentioned there, reliable measurement, extract future benefit, plan to use or sell, those cover the main points. The final expense, and the most common question or most frequent question I've encountered, is how does my organization treat the ongoing operating costs? Notwithstanding the capitalization of any development costs, which most accountants and IT professionals will understand, the ongoing costs for cloud storage associated service charges, and these can include access charges, license fees, or other related overheads such as account management, maintenance costs, etc. The regular charges for those should be treated as if one is purchasing a service. That is, they are an expense. I want to let that sink in for a second. You cannot treat ongoing charges relating to the use of cloud-based services as capital expenditure. Those regular service charges are an operating cost, operating expense, and should be recognized on the P&L as an expense. One must go back to the definition of an asset, and I'm paraphrasing here now. An asset is a resource controlled by the entity from which future economic benefits flow. Heavily paraphrased, but the key statement in there is you are not paying a service charge to create a new asset or enhance an existing asset. You might gain future benefit from the use of the cloud-based service. But the key word, control. The service provider controls the infrastructure your data is stored on. Your organization does not have an asset it controls. Let's contrast that with on-premises IT installations. Your organization may have a server room, a hot, noisy, windowless space occupied by an IT professional with questionable personal hygiene. The computers in that room, your organization controls. Your organization can decide what to do with them. File storage, an email server, an Active Directory server. You can even use it as a footstool. You can decide at any time to switch off and switch on those computers. The licenses on those machines are controlled by your organization, and they facilitate future economic benefit. They tick every box for the definition of an asset. Cloud-based systems, in comparison, your organization does not have control over. Cloud-based service providers can restrict what the infrastructure is used for. And they retain ultimate control by being able to prevent you accessing and using their environment. What you do control are those elements that are unique to your organization. The intellectual property generated bringing the cloud services into use. That is, the development costs. But as with everything in principle-based accounting, there are scenarios where a more nuanced interpretation can be applied. I've seen it argued that in the first year of development, to facilitate the creation of your organization's intellectual property and tangible assets, I have seen arguments for capitalizing the service charges from the cloud service provider in that first year. I strongly recommend discussing this with your accountants before making any decisions around that treatment. That is a summary of UK and Irish GAAP's treatment under Section 18 intangible assets. As the slide says, there's some more detail on Appendix 1. I'm now going to move on to the international accounting standards for these type of investments. Instead of going through a line-by-line comparison of the two documents, I'm going to go through a decision flow diagram initially. And that should give some steps that your organization could follow when considering the accounting treatment for these investments. The flow diagram will consist of a series of questions and then supporting tests for those questions. Before I share this, just to acknowledge a source, this is a visual summary of an EY paper from July of 2021 entitled Applying IFRS Accounting to Cloud Computing Costs. I've included the link to that document in Appendix 3. The first question is it a lease? And there are two tests associated with that. Does your organization have the right to obtain all the economic benefit from the use of the cloud computing application? And test 2 is, does your organization have the right to direct the use of the cloud computing application? Test 1, I think, is straightforward to understand. Your organization may have cloud-based processes or systems that are used to, for example, create competitive advantage and support your organization's customers. You gain a future economic benefit from that. Test 2 just requires an additional sentence or two of context. Does your organization have decision-making rights on how or when the system is configured? Or does your organization have decision-making rights over which hardware or infrastructure that the equipment is operating on, or the cloud computing application is operating on? If the answer to either of these questions is no, then we apply IFRS 16 leases to the entire arrangement. If the answer to both questions is yes, then we have to ask the second question. Is this an intangible asset? And this goes back to our definition of an asset. Does the cloud computing application give your organization a resource it controls? If the answer is yes, then a broad application of IAS 38 intangible assets for those costs that are capitalizable and for those costs that should be treated as an expense. If the answer to test 3 is no, then we've reached the conclusion of the process. This is not a lease. It's not an intangible asset. It is a service contract. A broad application of IFRS 15, revenue from contracts with customers, should be applied. It should be recognized that you may have created some intellectual property bringing the service contract into use, and that may attract some narrow application of IAS 38. I'm going to move on to a little bit more detail. Again, the implementation phases from an international accounting standard perspective. Now, this table is identical to the one you saw 2 slides ago for UK and Irish GAAP, and that's intentional. Where FRS 102 Section 18, UK and Irish GAAP, has approximately 3,500 words, IAS 38 intangible asset has over 12,500 words. With no disrespect to the authors and editors of UK and Irish GAAP, the International Accounting Standard is a more comprehensive document by virtue of the fact that it's nearly 4 times longer. I'll go back to my early point about comparing UK and Irish GAAP and International Accounting Standards. My comparison on this slide is grounded in the level of detail by virtue of a side-by-side comparison. As I'm sure you can appreciate, a lunch and learn session like this, it's only the briefest of opportunities to raise awareness and educate people. We won't get through 12,500 words of content on this slide. The reason why the table looks the same as the UK and Irish GAAP slide is that there is a significant amount of common ground. Everything I've mentioned on that previous slide is consistent with the International Accounting Standards. Both accounting standards are almost word for word the same when it comes to research, covered by paragraphs 54 to 56 in the International Accounting Standard. Research is recognized as an expense when it's incurred. Similarly with startup costs. Now, the list is a little bit more spread out, where UK and Irish GAAP has them grouped in one section. International Accounting Standard has them spread out across a number of different sections. But again, every one of these headings is called out in the International Accounting Standard. And again, training is treated as an expense. Development costs, they're covered by paragraph 57 of the International Accounting Standard, and they can be capitalized. And then the ongoing operating costs. Now, that goes back to the definition of an asset. So for International Accounting Standards, that's covered by the conceptual framework. There are differences between the two documents, but there are no inconsistencies. There's no contradictions. There's nothing that's said in the UK and Irish standard that contradicts what's in the International Accounting Standard. Appendix 2 below, because the UK and Irish GAAP appear to follow International Accounting Standards so closely, I've included some extracts where the International Accounting Standards provide some additional clarification, some detail, and maybe some additional color. These include acquisition as part of a business combination, paragraphs 33 to 37. Again, there's no inconsistencies here. Both standards cost the intangible asset at the fair value as at the acquisition date. But the International Accounting Standard goes into more detail around the uncertainty of that fair value. And it also includes a very interesting option or guidance and principles around potentially grouping complementary intangible assets into a single asset. The accounting standard includes an example of including different brands and trademarks and grouping those intangible assets together as part of an acquisition. But you could apply the same principle during an acquisition of a business to a number of different IT intangible assets and potentially group those together as a single intangible asset. The other thing, again, that I found quite interesting when I was reading the accounting standard is that International Accounting Standard is very clear about some additional items that must be expensed. Paragraph 67 specifically calls out identified inefficiencies and any initial operating losses incurred before the asset achieves its planned performance. These are to be treated as an expense. They are not components of the costs of an internally generated intangible asset. This is my penultimate slide. I just want to very, very briefly mention US GAAP. US tends to be a thought leader on areas of technological development. That's because most of the large software companies are US based, and they tend to influence financial standards in that jurisdiction. There's nothing on this slide here that fundamentally contradicts what you see under both international or UK and Irish accounting standards. But one area where there is a little bit more clarity, and you don't have to extract the implication yourself from the accounting standards, is around post-implementation stages. US GAAP calls out that the operating costs for licenses, service costs, etc., these are clearly articulated as being expenses. The basis for this slide is FASB intangibles, goodwill, and other. And again, I've included a link down below in the appendices that Jean will circulate later on. And that's my presentation. It's a whistle-stop tour of UK and Irish, international, and a very brief touch on US GAAP. Started with an introduction on what cloud computing is, spoke about the benefits and risks, spoke about some of the investment scenarios as well. Hopefully it's been beneficial. Just a couple of thank yous before we move on to Q&A. Just want to thank Jean from CIMA's offices in Dublin for your support organizing this, and also the 2 previous events for the Southern region. I want to thank Robert Kirk from the University of Ulster, who helped prepare this by reviewing the content of the presentation with me. I'd also like to thank my Southern Region Committee colleagues, Mary Hayden and Margaret Rossiter, who sat through this presentation on more than one time and helped me fine-tune it. And finally, I just want to thank you all for your attendance and your questions in a few minutes. As I said, Jean will be circulating the presentation. I wish you all the best, and I look forward to seeing you all at Croke Park for the gala dinner on April 26th. Jean.
Hi there. Lovely. I'd love to welcome Mary Hayden and Kojo Salermi to join now. Both Mary and Kojo are fellow members of the CIMA Southern branch, as Diarmaid has pointed out, and they've kindly agreed to facilitate the Q&A today. So do you want to kick in there, Kojo, please?
Thank you very much indeed, Jean. So firstly, just a reminder to everybody, if you wish to ask a question, please do type it into the question box at the bottom of Zoom, and we'll attempt to get to all the questions now. I've just got a couple here to start off with, and maybe Diarmaid, if you were in your organization now starting up a new project to implement a cloud computing solution, what were the first 3 things you would do to make sure at the end of the process all the accounting treatments were correct?
I'm just after having a meeting an hour ago where we were discussing that exact question in the context of a project. The first thing I would say is that if you have a project manager and your finance manager, that they need to agree out at the start of the project what the accounting treatment is going to be. That's extremely important. Your IT professionals and your finance professionals need to be on the same page. So that's the very first thing you need to get right. Getting those stakeholders in a room, virtually or in person, and trashing out, this is what we're going to do. This is where these costs are going to go. Project manager, can you please make sure that all of the costs get correctly routed to the correct pot, for want of a better word, whether that's on your accounting software or on an Excel spreadsheet, however you're managing it. The second thing then is translating that into your accounting software. So I work in an organization that uses SAP, so making sure that the WBS codes in SAP are correctly set up. I'm not familiar with Hyperion or Oracle or any other system like that, but again, it's the same principle. It's making sure that what is agreed with your project managers and your finance professionals is set up straight away at the start of the project to ensure that there is a facility to be able to book those costs to the correct pot of money. The third thing then is, I think, regular communications. That's essential. Not just at the start of the project, but regular touch points during the life of the project. Projects ebb and flow. There's some fast sections, there's some slow sections. Regular monthly, quarterly reviews of the finances with the project manager, the project sponsor, and the finance community is essential to ensure that the project stays on budget, and if there are changes in scope, that they're clearly communicated and that the budget is correctly captured. If there's changes in timelines and projects running to multiple years, again, that the finance team are aware of that. They would be my main top 3 things before you start a project. Get all of those things in place.
Brilliant. Thank you so much. You also mentioned as you were speaking that development costs can be capitalized, but the ongoing costs can't. Oftentimes in projects, you get one big bill for all of the work of maybe the first year of service. Do you have any hints and tips for your experience about how you sort of split those things out?
So there's a couple of things. It depends on how the project is being delivered. Or the implementation being delivered. So the accounting standard call out 2 separate scenarios. There are multiple ones, but the 2 I want to focus on are either a separate acquisition, which is where you buy something, or you internally generate the intangible asset yourself. So in both of those scenarios, they will both attract different processes. For the separate acquisition, it's being very, very clear with your vendors that you want itemized invoices, so that you can very clearly track when they delivered a training course and how much that cost, when they developed software unique to your organization that they developed on your behalf. That would be for a separate acquisition, and ensuring that you clearly communicate that the reason why you're doing that is because you want to be able to account for these things correctly by making sure that you expense what needs to be expensed and capitalize what needs to be capitalized. For an intangible asset that's internally generated, I mentioned timesheet systems to be able to track accurately your internal resources time. So somebody that is writing software, doing testing, anything that's contributing to the development around your cloud computing application, making sure that that time is clearly ring-fenced and can be clearly identified and then capitalized. But you could have the same resource, and I frequently see this, where the IT professional who's developed something also is the person that's training his colleagues on it. So that training time, very clearly called out as an expense. A timesheet system would assist you in actually isolating the time that was spent preparing the training literature, delivering the training. So in those 2 scenarios, a separate acquisition, very well communicated to your vendor that the invoices need to be itemized, and internally generated, a good timesheet system to be able to track the time.
Thank you so much for that, Damon. Just a reminder to those of you on the call, please feel free if you want to go ahead and ask any questions to do so. I have one more here. You just mentioned there about obviously using the tracking the timesheets. Obviously, one of the challenges that gives you is, are you using your actual cost in terms of your salaries and wages, or are you using a standard cost to derive that? Do you have any experience of which side of the fence you sit on when it comes to particularly to capitalization of development costs?
I think you have to. I've seen both. I saw both. I saw in the UK, an organization was working with the UK, and they had a payroll plus overhead was their approach. I've seen here in Ireland where it is just payroll. And my understanding is that the accounting standard is quite clear that it should just be direct costs associated with the actual development. I think you have to, each organization needs to make its own decision as to whether they want to, what they want to do in terms of how they want to, what they want to capitalize, what they want to recognize in the balance sheet. And I think they need to have that conversation with their own accountants. My UK colleagues were, it was a big exercise every year to try and calculate, this day rate included this man's pay plus a portion of his manager's time plus light and heat and whatever other expenses, and that was how they arrived at the day rate. And it was a big exercise every year to do that and make sure that those numbers were accurate. While another organization here in Ireland, it was very black and white: pay, and that's it. That's the only thing you can capitalize. So both organizations were very large. Both organizations would have had Big Four auditors. So they would have got guidance from their auditors as to what the treatment should be. And that would be my recommendation to anybody listening. Speak to your auditor, speak to your accountant to get their guidance.
Thanks for that, Gemma. I've got one question here that Michael has raised, which says, recently we moved to a new insurance system built on cloud. It is an industry standard system, but we had to bespoke it significantly for our business only. The bespoking of the system incurred large development costs, which we subsequently had to recognise as an expense despite my arguments. How does Diarmaid now view this direction we received?
Well, you sure you don't work for my organisation? Because we're doing an insurance system too. It seems if that's the guidance you were given, I'm sure it was given with sincere intent. It depends on what you mean by bespoke. There are configuration, and then there's customizations. Configuration is when you take a third-party software and you work within the confines that vendor has set in terms of what you can set up, what you switch on, what you switch off. That's configuration, and you're just configuring somebody else's software. If you're customizing something, if you're doing a lot of customization, that is when you've taken the vendor software and you are adding your own bits and pieces to it that are unique to your organization. Based on, I don't know whether you're UK and Irish GAAP or international accounting standards, but the principle remains the same. You have created something that you're going to gain future economic benefit from, that you control, nobody else can use, and you plan to use it or sell it. And assuming you've been able to reliably track the cost accurately, going back to Kozo's question there from a few minutes ago, it ticks all the boxes from an intangible asset perspective. Now, again, there is that distinction between customization and configuration. So just make sure that when you are, or if you have spoken to your colleagues about this, that it is when you use the word bespoke, that you are referring to customizations and not just configuration.
So thank you, Diarmaid. I think that brings us to the end of the questions. Maybe one final call. I can see a couple of folks with their hands up. But are there any other questions folks would like to ask before we go ahead and close the session this afternoon? I think just one more has just popped in. Thank you, Michael, for thank you for attending. Any other questions before we wrap up for today?
I just want to say thank you, Diarmaid. That was very comprehensive and great to have the recording, because there is a lot of information there. So to be able to go back and look at it again, it's excellent to have. Thank you.
Delighted. Thanks for that. Thanks for the invitation to present.
Okay, thank you both. And Diarmaid, obviously on behalf of CGMA Ireland, we'd like to thank you for your informative and interesting presentation, reiterating what Mary has just said. And to Mary and Kojo, thanks for your participation. We appreciate your time. So thank you all for attending. We hope you found it beneficial. As Diarmaid said, I'll be sending a follow-up email shortly, which will have the recording and the presentation. I'll also include the first 2 recordings of the 2 webinars from the previous from the series. Should you have missed those, so that you can watch them at your convenience also. So thank you all. Take care. Bye now. Thank you.